I will be taking place for Pablo today for today's training. And I am really looking forward to it. It's been a while since I've done a training with you all. I know that we have had a few um, requests for training when it comes to what we're doing on the compliance side of things. So today is going to be more geared towards that part of the operation. And we're going to start with EPOs. Okay, so while everyone else starts filtering in, we're going to just go ahead and get started. And yeah, please know that this is all for your benefit. We know that there are going to be more EPOs coming up within the foreseeable future, just because it's the nature of being in a, having refis come back. Although, recent weeks have shown that we're kind of back to where we started prior to the rate announcement. So in any case, this is going to be prep for all of that. So I'm going to go ahead and share my screen, okay? And we'll go ahead and get started. Just give me 1 second. All right, so I think everyone can see my screen now. Like I
Yes, we can
mentioned,
see it.
perfect. Thank you, Carmela. So we're going to be going over EPOs. I think everyone knows what an EPO is already, but we're just going to start with some of those basic things, right? So early payoffs, right? It's basically a prepayment penalty. Now, back in the day, right, there used to be prepayment penalties that would be, the responsibilities of, or the responsibility of borrowers. But it's not so common anymore that borrowers pay the EPOs. That is something that is considered not a good practice anymore. In fact, all of our lenders actually make us sign agreements where they go over what their EPO policy is. And you can imagine having about 150 plus lenders, every one of them is a little different. So that's why we go through review processes when we get a new lender. Sometimes we have our loan officers just like send us a lender to say, hey, I want to get approved right now. And that's all well and good. However, these are the fine print details that we look into to make sure that we're aware of what the EPO policy is, as well as some other details, of course. But you'll find that they range from 4 months to 12 months. I would say the standard that I see as kind of like an average is somewhere between 4 and 6 months. Some might have EPO policies that are 3 months. Others might have them for a year, 2 years. So really, it's something that varies from lender to lender. At the moment, or what we've been doing actually consistently now is logging all of the EPO periods for each lender. And that's something that we track. So if you're ever in doubt about a lender's EPO policy, though, you can email us at LO support, or you can email the lender and make sure that you're aware of what their EPO policies are. As I mentioned, they are different from lender to lender. Now, I do get questions as to like, why do the EPOs even exist, right? And to understand the whole reason why they exist, you kind of have to put yourself in a different perspective, in a bigger frame, or a bigger, like, look at that bigger picture. Lenders are participating in the secondary mortgage market, meaning that they often are selling loans on to, the pulling loans together and selling them on with a Fannie Mae, Freddie Mac sort of guidelines. And those loans get pooled together, which requires that those loans are actually being serviced for a certain amount of time. And if there's not a trigger point isn't hit, then it can actually lead to a loss. So really the EPO policies are there to make sure that there's a certain minimum amount of revenue that the lender is able to make. And if they don't make it, then they basically shift the burden back to everyone back up the line. So it's a way to create that sort of accountability and stability in our market. So that way people aren't going to be refining every 30 days. Back before, I would say in the early 2000s, and even before then, you would have some loan officers that would refi people as often as they could, right? And try and collect the origination premium. That's not really allowed anymore. And in fact, you can get in a lot of trouble with a, relevant state regulator for performing origination for a consumer that where there's no real benefit to the origination. This is called, like, I believe the term is called churning, when you're actually just doing origination just for the sake of collecting the origination charge with no tangible benefit to the borrower. That's actually not only frowned down upon or unethical, but also out of compliance. You can't do that. So EPOs are there to hold that accountability as well, to make sure that loan officers aren't going out there and trying to just collect origination fees. And then, like I mentioned, it's a way for lenders to recover costs associated with funding the loan. So those are kind of the main high-level points when it comes to EPOs. I'm going to go ahead and check our questions quickly and see what we got here. Is it from COE? I'm guessing, if you mean, is it from close of escrow? Maybe you can be a little specific as to what you mean by that, Gangor, and I'll try and answer that for you. But the EPO also is different from the commission. Yes, yes, it is, because the commission is a portion. I guess if you're speaking, I'll speak to Rhonda's point here.
I can rephrase it if you like, Serafin.
Yeah, no worries.
What I meant in that question was that, lenders have EPOs, but on the commission, sometimes that if it's paid back before 6 months, then you have the early payoff, which results in a withdrawal of commission. Even if the EPO for the lender was, let's say, 1 year or so forth. So there are certain loans that it doesn't matter on the EPO and some that do. So I guess I was saying that, yes, the EPO is affected. The lender has EPOs, but also within the commission standpoint, if it's paid back within 6 months, you generally always lose your commission unless it's a fix and flip loan.
Yeah, so I understand what you're saying. So, but just to be clear, from a lender perspective, an EPO is triggered if it violates their EPO policy, right? So this is irrespective of our internal policies. That our policies are actually made in a way to mirror whatever we experience as an EPO. So there is no padding or anything like that to cover our administrative costs. It's literally a pass-through sort of situation. Everyone's passing through, basically. So, and the whole point is to collect back what was paid as a premium to offset losses. So in certain situations, there of course are, EPOs that, like, it won't matter if there's if you originate in a certain time frame. However, as a rule of thumb, you shouldn't be originating or refining people within a 3-month time period. That's already very way too soon. And ideally, after 4 months is when you can look back on it at the very minimum. As a best practice, after 6 months. 6 months is usually your what you're looking at between originations. And like I mentioned, the EPO is a pass-through cost. We experience the EPO as the broker. And so what we have to do is collect the premium that was paid out as well, because we're paying it back to the lender. So it's like I mentioned, everyone in this sort of bigger picture of what's going on, the secondary, we'll call them the purchasing investor, which is the investor that purchases on the secondary mortgage market. They're purchasing from the lender, right? Which, let's say, just to make things easy, let's say UWM was the lender and they're going to sell the loan on to Mr. Cooper, right? So Mr. Cooper is the purchasing investor. They get, notice of this, early payoff. Now they're going to make UWM pay them back. And now UWM is going to make us pay them back. And now we're going to make you pay us back. So that way we can make sure that everyone up the line is made whole. That's how the EPOs work. So they're all pass-through sort of costs. Now, I would just assume that that there is always going to be an EPO within 4 to 6 months of originations, unless otherwise stated. That would be the exception if there's not an EPO that's going to go into play. If you originate sooner than 4 to 6 months. Otherwise, I would assume that an EPO would happen, and you have to, really build that into your thinking when it comes to what's going to be like how you're going to be working with borrowers, right? Because I see time and again loan officers that are thinking about that specific transaction, but not thinking down the line. Okay, is this person, if rates come down in the next, 6 months, is this person going to refi again? Are they planning to sell that home soon? Well, like all these things have to be kind of, in your thought process, and you have to be having those transparent conversations with your borrowers, because that's how they know what to do. Right. A lot of times, borrowers don't even know that there's something called an EPO policy sometimes. So they don't even know that by refinancing, they may in fact impact you. So there are things that you want to make sure that are being disclosed up front. That way, what's going to be going on with that borrower and how to be working with them, strategizing with them in the future. And if you know that they're going to be refinancing within 6 months or sooner, don't touch it. That's not something that you want to, be doing, because you will be forced to pay back that EPO. So just want to be clear there. Now, I want to pivot over to some of the rules regarding EPOs, right? Because, you'll hear a lot of stuff out there as to what you can and can't do. I've already mentioned some of that, but I'm going to mention it again here. Be communicative, right? Make sure you're communicating with your borrowers and letting them know that really they should be holding on to this, loan within at least 6 months. Okay. And I would advise you, just as an extra step and to provide your own peace of mind, make sure you're clear about what the EPO policy is with that lender. Right. You want to make sure that you know exactly what you're dealing with, not have a vague idea. It does happen where we start to confuse certain lender policies with others, and that can lead to problems down the road. So I want to mention the avoid misleading practices. I'm going to mention this a few times throughout this presentation. You can't make consumers pay for your EPO. Sometimes I've heard LOs saying like, "Oh, we can make the consumer pay for the EPO." You can't do that. Cannot do that. I want to be very clear there. Unless it was written into the loan documentation by the lender itself that that the prepayment penalty would apply to the consumer, then that's not only like out of compliance but borderline illegal. You can't pressure the borrower to be paying something that ultimately is not their responsibility, right? It'd be lack of proper disclosure, and that leads to problems on the road. Again, if you have any questions about this, I am more than happy to talk about that, a little bit more in depth. Maybe you have something that applies to your specific scenario. It's always good to have specific scenarios, so we're not talking about general sort of practices, but as a best practice rule of thumb, consumers aren't going to be paying EPOs. That's going to be something that us as the broker will pay for, and then of course you'll have to put over your forfeit over your commission as well. So just be aware, and I know it sucks to have an EPO. That's why I'm talking about them now, so we can manage expectations. But just be aware that that's a really bright red line that the CFPB expects us to abide by, and all our lenders do too. Remember, that's why we review their agreements. And protections, right? So we have to make sure that we're just protecting the consumer at the end of the day. Remember, our industry, especially after 2000, like 2007, 2008, was heavily redirected towards protecting the consumer, right? I mean, it's in the name of the CFPB, right? Consumer Financial Protection Bureau, right? It's all about protecting the consumer. So you have to understand that all the policies really that are there right now are there to protect the consumer. They're not necessarily there to protect the loan officer. I think we all know, that in the early 2000s, a lot brokers got really shouldered with the blame, even though it was not fair. We got shouldered with the blame with what happened in that subprime mortgage crisis, and that led to that whole global recession. So all the policies are going to be there to protect the consumer, not to get them to pay things that they ultimately didn't agree to pay. Right. So just keep that in mind. If you ever have to err on any side, always err on the side of caution, always err on the side of the consumer. That is a good Northern Star for you all. But if you have any questions, please reach out to me. I'll be sure to help you all out. So kind of already mentioned this again, but we'll mention it here. Know the EPO guidelines, know the compliance that surrounds them. Which is what we're doing this training for. It is going to be recorded. And know that really you're expected to have transparent communication with your borrower. I am going to pin it right here. I see I have a hand. Julie, why don't you unmute yourself?
Hi there. You said something that kind of made me think, oh, maybe there's another way, or, did you say that we don't have any agreements with the lender to not have these types of EPOs? And I guess it's because of a competitive thing. If everybody's doing the same thing, then we have to do that too. But could Equity Smart negotiate so that at least part of it might be paid by the lender, or not the lender, but the borrower, so that we could, I mean, as long as we're transparent and say, well, if you're willing to pay a prepayment penalty or something, then we can get you, X rate or something, or if you're not, then, this is the other rate, because otherwise it's a 6-month prepayment penalty from the date of close of escrow, right?
Yeah, no, I hear you. And we do have those conversations with lenders.
Mhm.
It's always something that we bring up. However, you'll almost all lenders have an EPO policy as a standard of practice, right? So really the market dictates how the rest of lenders operate. And most lenders got rid of prepayment penalties to borrowers in the early 2000s. So no lenders really expect borrowers to shoulder any of that burden, but they do expect to collect it at some point from someone, right? So yeah. I mean, so we do advocate, if that's what you're asking, but every lender is different. And it's really going to be driven by those lenders that we experience. So you'll see later on, like on this presentation, we do have something with UWM now where we have EPO protection policy with them. But that's because of the amount of volume we drive towards them. Not all lenders are going to be open to these sorts of arrangements though, because they need to know that there's a way, some sort of mechanism to collect the money back. So let's say you have a very niche lender who expects, who has this EPO policy, but we only use them every once in a while. They're not going to be open to it. And neither, I mean, and although I love to be advocating all the time for us, we also have to see it from their point of view. And they most likely, I mean, I wouldn't, if I was on their side, I would also advocate that we would want to see more volume before we can have that conversation. So, but I share that with you so you have a better idea of what the positions are. Not all lenders are even open to entertaining the conversation. Sometimes you get flat out denied, unfortunately. So, but yeah, we do have those conversations, Julie.
So that's not even something that, like, if we're dealing with a customer, we can say, this is the rate with a 6-month prepayment penalty. I mean, because we can't do anything because we're not doing we're not directly lending the money, right? But if we were doing the what do you call it? The other one,
where we were direct lending, yeah, it'd be different.
If we were direct lending, then we could write something in there and say, kind of as an intermediation or something that's saying that, hey, if you refinance within 6 months, then you don't use us or something like that, then we're going to charge you a prepayment penalty for 6 months, right?
Yeah, but we can't do that right now, unfortunately.
All right, just on safe.
Yeah, yeah, no, I hear you. I hear you. It's honestly like a common problem in our industry.
Yeah.
And it's just one of those things, unfortunately. So, but I hear you. I mean, we do try and we do try and head these things off as best we can, but ultimately, like, there will most likely be a situation, if you've been in the industry for any length of time, where this will come up. So yeah, but
Yeah, I know. All right.
I'm gonna see what other questions we have.
Serafin, it's Rhonda. Can I make a comment?
Yeah, 1 second, Rhonda. I want to make sure I get to everyone. So I'm gonna read Leo Meneses. Isn't it better and easier that the lender establish some kind of prepayment penalty to the borrower before an EPO can trigger? Of course, it would be better, but you have to remember again that the lenders are following the market, and almost no lenders expect borrowers to pay a prepayment penalty. So there are some companies that do allow for that, but I would say those are probably like your your unknown lenders, like UWM doesn't do that. Like none of the like top 25 lenders do that. I'm sure that if I dove in even deeper, I would find that even more don't allow for that. And that's just because, remember, all the lenders are competing against each other. So what one lender has as a hard stop policy, like, oh, you're a prepayment here, another lender will say, oh, we don't have prepayment penalties here. You don't have to worry about that. So again, like it would be nice. It is possible. The CFPB has rules about this sort of a mechanism, right? The prepayment penalties, like you have to do it within 3 years in order to be able to charge a consumer this. However, it's not common practice. So even though it's possible, it's not something that we see typically. So that's why I say err on the side of the consumer being protected, because that's what the market is about right now. Unfortunately, like it's not like we have a like a sympathetic like sort of ear when it comes to consumers in this sort of space, because consumers want to be protected above all else, right? So that's kind of where we're at. NAM and other associations do advocate for protections like this, and I do have connections there, but it's not really like a something that's really being seriously considered at the moment. Who protects us? That's a great question, Monica. The best thing to do, so we're protecting you guys by having the conversation right now, but also advocating with the lenders. So like I mentioned with UWM, we do have EPO protections. With all of our other top lenders, we're going to be continually advocating for more EPO protection, and we'll be notifying you all of that once we get more information from those lenders in question. However, the best thing you can be doing is making sure that you have conversations with your borrowers, really making sure that you know that they're not gonna, that you feel assured they're not gonna be refining within that EPO period. Otherwise, it will be something that we have to deal with down the line. That's true, of course, and you want to mention this. Gangor mentioned that customers do refi without loan officer attention, and the LOs have no control. That unfortunately is true. So the best thing to do is make sure you have that sort of rapport with the consumer, and make sure you're building that relationship with them, so that way they're not going to be refining within that time period, and to also let them know, right, what happens when EPOs get triggered. It's not ideal for anyone, unfortunately, but like I mentioned, the industry, the regulators are going to protect the consumer. They're not going to protect the broker. They're not going to protect the lender as much. They're going to protect the consumer instead. Yeah, and then just like Michael mentioned, chargebacks are there's a part of this environment, unfortunately, right? So that's why I mentioned again, we are starting the conversation here, and with our more active lenders, we do have a lot more leverage to try and have lower the EPO policies to something more manageable, or to get rid of EPOs altogether under certain circumstances. So that's something that we're taking seriously and we're doing. But again, the best defense you have here is just educating your borrower, educating your client, making them aware of the consequences for EPOs in an advisory sort of way, right? We're not trying to pressure them, right? But advise them, right? And you want to have those conversations early. Don't want to bury your head in the sand about them, because there's nothing more upsetting than when you get a loan done, clear to close, everything's good, and then you get hit with an EPO. It's probably one of the most disappointing things to have happen to you. So have the conversation early. Okay, so we're gonna go over to onto some do's and don'ts. Do's. Make sure you educate your clients. Make sure you have everything documented, right? I can't tell you the amount of times where I'll speak to a loan officer and they'll say, "Oh, it was over a phone call," and okay, do you have something in writing? And they're like, "No, it's just phone calls or just hand scribbled notes." Get everything documented when it comes to conversations with borrowers. That way, what was said. That way, you can have a clear track of everything. However, you just want to make sure you have everything documented when it comes as a best practice, not just for EPOs, just as a best practice, right? stay updated. This is something we'll help you guys with, right? And not just with regulators, but with lenders, right? So we'll make sure that you guys are up to date on everything here. And like I mentioned, just providing the resources, which really is yourself, right? Make yourself a resource to the borrower. Remember, a lot of times they don't really see the bigger picture. So it's on all of us, but especially you as a loan officer, to help them see a bigger picture. That they usually, it's not in anyone's best interest to refi within that 6-month period anyways, right? So you want to make sure you're there present as an advisor to help them make those decisions, as opposed to, having them feel like, oh, this was just a transaction and I'm just gonna keep on doing what I think is, the best, because oftentimes, consumers need the guidance in order to really make the moves that are in their best interest. Now I'm gonna go over those don'ts. Don't hide the EPO conversation or info, right? Like, again, you want to make sure you have the conversation early about the length of time they plan to be in the home or have that loan, and strategize with them when it makes sense for them to actually refi, right? So you want to make sure you're having those transparent conversations. Don't pressure the borrower, right? Don't, and I'll say this in two ways. Don't pressure them into a loan they're not ready for, because there's a few things that happen there. One, it leads to cancellation at the end of the loan when things are about to close, which I've seen more than once, way more than once. I've seen multiple times. Or they realize they can't afford the loan, and when they're in the loan, and now it leads to a whole slew of issues for the borrower, but also for you as the originator, right? So don't pressure a borrower into a loan they're not ready for, into a commitment they don't not sure they can make yet. Because that's only going to come back around. Okay, so just be aware of that. Assumptions are something we have to do, kind of throw out of what we work with as like a valid reason to execute something. We don't assume knowledge. We always meet them where they're at and educate them. Okay, don't assume that they even know what an EPO means or prepayment means. You got to give them all of the information and make sure that they know what to do. And like I mentioned before, you can't demand the borrower pay. That's something that is a big no. And but if you have questions, you of course can reach out to me. But like I mentioned, the borrowers are not going to be paying your EPO. That's something that's your responsibility and that we will work on together. Okay, but I want to assure you guys, it's not all like fire and brimstone and like bad news here, because we do make sure that we work with you on those EPOs, right? We know that sometimes they come at the worst point. I just want to make sure I highlight here really quickly, because I know I'll have more questions. All lenders are going to be a little different, so just keep that in mind. This is kind of example of an EPO right here. They're really boring, but it's exactly what you expect. If a loan is funded and then paid off in full within 180 days or on the 6-month, something to that effect, then there's a EPO or reimbursement is expected to the lender. They usually just call them EPOs though. And we're expected to usually pay within 10 days, sometimes sooner, sometimes you get a little bit later. But if you are in a position where you get an EPO, you want to know what you have to do, right? And typically our office receives the EPO notice as well, because we're the broker. But you of course want to make sure that if you do get an EPO, you're thoroughly reviewing it. You're verifying the lender's EPO policy, which we will do, of course. I'm just making you aware of what we do. You should do it as well, though. Due diligence always works in your benefit. We document our agreements and make sure that we have everything notated. The lender lists have EPO dates inside of them. And you should always make us aware. I mentioned we should be receiving these, but sometimes lenders just assume that you're going to be sharing the EPO information with us and don't share it with us. So in every single case, you should always send us a notice of an EPO as soon as you get it, because we can work with you to make sure that everything is done and like properly. Don't think that you're like out there on an island by yourself and there's no one there to help you. That's not true. We're here to help you. So it's in your best interest to loop us in, make sure that we are aware and that we can do our due diligence with the lender and work with you to make sure that this gets, taken care of. So just make sure of that, okay? And we'll make, after this happens and we determine, yeah, there is an EPO, we're gonna have to make plans to pay that EPO back. We're happy to work with you on that, okay? I mean, if there's something, there's concerns there, just let us know, reach out, and we can work something out. However, I want to call out a behavior that I see sometimes, and it's just not acceptable. And that is when we just ghost or we put our heads in the sand, and then we just don't respond to our emails or phone calls. And stuff like this, we want to help you as best we can, right? Again, we know that it's uncomfortable, it's not fun, it's just, it's stressful sometimes, and I know there's like emotional triggers and everything. I get it, trust me. I've been in this industry to know, that I've been in this industry long enough to know that that happens, and that's okay. But really, you have to keep us on the same page. You have to make sure that you're available for a conversation, so that way we can work with you. Otherwise, if you just like try to ignore it, it's going to lead just to more issues down the line. So just be aware that we're here to help. And as long as we're able to communicate and figure out something that works for everyone involved, the lender, ourselves, you, will be okay. But just don't disappear, because I've seen it happen before, and it just leads to complications when it comes to stuff like this. So just want to make you aware, we're here to help. It's I know, uncomfortable stressor, but our team is here to make sure we can navigate through it. And then when this happens, finally we get to this side or part of it, which is just reviewing what caused that EPO. Obviously, we'll do that sort of thing together and adjust, right? We have to determine what led to the EPO happening. Sometimes it's an unfortunate set of circumstances and there's literally nothing you can do. And that's a hard pill to swallow. That, especially when we want to control, sometimes we realize we don't have all that control. However, sometimes there are opportunities for us to improve. So we can do that work together and make sure that we're making the adjustments. I put this here as an optional, which is to communicate with your borrower. Okay, so if you do receive the EPO, I do encourage you to communicate with the borrower, figure out why they're doing it, and address any concerns that they have. Again, they don't have to provide you any notice that they're going to be refinancing. Like sometimes, I get it, there's like personal emotions tied up in stuff like this. You're like, I trusted that borrower, another refi on me so quickly. I get that. And if that's your response to it, if that's your reaction, I would say don't reach out to them, because you're not trying to have a confrontation with a borrower that ultimately doesn't really have to provide you any sort of notice. That's where the relationship driven part of the business comes into play. We want to understand, see what's going on, see how we can help them. What would trigger this sort of EPO? Did they know what was going on? That's when you want to have that conversation so you can learn and make the adjustment. But if you're going to call them to confront them, don't reach out to them. That's not going to lead to anything good. Okay. But I would say, from a position of wanting to learn, it's something to do for sure. Again, we can advise you if you find yourself in the situation. Now, because people are starting to get ready for refis, there's a lot of like messaging and programming right now going into the media about like why you should refi and like be ready for the next rate drop and all that kind of stuff. That's all happening right now. So I will say it's going to become more common, which is why we're having this training right now. I don't think within like, I don't want to be a false prophet, but I don't think that within the next 3 months, there's going to be a lot of EPOs triggered. I would say this is something that might be happening middle of next year to maybe third quarter of next year, depending on how rates go. But when we were to give you an idea, right? When we were in like 2020, 2021, we did record like I would say about like, out of like the hundreds of loans we were doing, we were recording maybe like 1 to 3 EPOs max. So even in a heavy refi market, we weren't seeing like it wasn't like 1 out of 2 loans were EPOs. It's still like a very small chunk, not even chunk, I would say, very small segment of loans that will be affected. So I would say the majority of people won't feel an EPO, but the thing is, when an EPO happens, it's very easy to get blindsided. We're like, what? I didn't expect to pay out like thousands of dollars back, you know? So that's the reason why I wanted to mention this for you, because it honestly, it's not a fun feeling to see it come through. So yeah, but it does happen. And that's when I say, instead of kind of going into like, oh man, like that sort of negative mindset of like, oh gosh, what does this mean for me and how am I going to make things work? Like, that's when we have to like plug our team in play. Like, you got to reach out to us, say, hey, you know, I'm letting you guys know I received an EPO policy. Please advise. We'll reach out. We'll advise. We'll help you get through it. You know, like I mentioned, sometimes there is a narrow window to address a situation and avoid it. In the event that we're not able to, then at least we're able to, you know, work something out. But it's not like a huge amount of loans that get that have EPOs. Honestly, it's, I would say, on the more uncommon side of like regular production, but it does happen. Yeah, we do have a certain amount of time to pay back if it happens. Usually we have to pay back within 10 days. So that's something that we have to do as a brokerage. That's why you have to, you know, we have to be on the same page and make sure that if you do receive EPO or we receive EPO, that we're in communication. But some lenders are different. Some will provide us grace. They just want to know that it's going to get paid back at the end of the day. Okay. All right. Any other questions, guys? I know that we're running close on time, but it looks like I was actually able to finish on time and not go over. So I'll leave it open for a few more questions. Otherwise, thank you guys for our meeting today. I hope you got some value out of this. We'll make sure that we put this on my ESHL under the training library, and it will be there for reference. Okay, guys? So thank you again. If you want to hop off, feel free to do so. I'll stay on here for a few more minutes.
I have a question. So 10 days is a very short period of time. So how is payment given? How can someone pay that back? Let's say it was a lot of money. I'm just questioning that. How is it paid back? What are the methods of payment?
Yeah, so we could work with you. I mean, we have to pay, as a brokerage, we have to pay back no matter what. So we are held to that standard. So if it's 10 days, sometimes it's 10 business days, sometimes it's a full calendar month. It varies, right? But I would say in stuff like this, it's safer to assume the shorter end of things, because lenders want their money back, as I would too if I was in their position. However, we could work with you to either create a payment plan or to offset against future commissions. That's something that we're more than happy to do with you guys. But we have to be able to reach you. We have to come to that, you know, understanding together. We're not going to make any assumptions on your behalf, especially if we can't get in touch with you. Because to us, that's concerning if we can't get in touch with you, right? So, but if we can't get in touch with you, if we're able to speak with you and have that mutual understanding and create that sort of win-win scenario, then we're more than happy to create a plan that works for your specific situation.
And how are you notified? Does the lender email you? Does the lender call the LO? How do you receive notification of an early payoff?
Proper notification will always be through email. And so even if you get a phone call, it needs to be confirmed through email. So it's like AE says, oh, you have an EPO or something, be like, yeah, I need you to send me an email. That's otherwise it's improper notification. And like I mentioned, sometimes the AEs don't, or the lenders aren't aware that that they should be sending it to our office. So never assume that they have. You have to send it to us. So you can send it LO support at Smart Loans. Remember, guys, like that is like a catch-all sort of email address for everyone, and it will make its way to the proper person very quickly, I assure you. Ideally, the lender notifies us too, but if you get notification, just send it straight over to us. That's the best thing to do.
Thank you so much. This was a great webinar.
I'm glad you guys found it useful. I know, like, so what happens a lot is because it's an uncomfortable conversation. Sometimes people don't want to right? And so if you don't talk about it, then how are you supposed to plan for it, you know? And obviously we don't want it to happen, but knowing that that it's there and just assuming that there might be a time when it does happen, we can plan for it better, right? So I'm glad you found it useful. I think I heard someone else unmute themselves. If you want to mention anything or ask a question, please feel free to do so. Okay, all right. Well, I think I got everyone. Thank you guys so much. I really appreciate you for sticking with me for this training, and we will see each other again soon. Okay. All right. Take care.